Apple faces a blowup and it could spiral into an all-out doom loop. I'm Steve Van Metre. Chaos at the markets today, sparing no one. A storm's about to hit the iPhone giant, as you're about to see. They're not the only ones. Stay tuned because this can only be described as unreal. Now let's over to Bloomberg, where he picked today's story up with a headline from Apple Equities Research Department saying new global tariffs are likely to degrade Apple sales and hit the margin. But the issue is this is not just Apple. This is any company that imports, whether it's a full product or even parts of a product from another country. They're going to be faced with massive tariffs, and this leads them to facing some massive decisions. They're going to have a huge impact on the U.S. economy. The U.S. reciprocal 34% tariff on China and other nations where Apple has manufacturing will likely amplify operating margin deterioration, given we don't expect the company to hike prices to offset the effects. So this is one decision companies are going to face, is not hiking prices, and that means they're going to have to take a hit at the margin. And since equity markets price in profits, well, it's going to be a big issue that could send stock prices plunging even more than they already are. And this is the early signs, because these companies are facing a double-edged sword. You could raise prices and find out consumers already can't afford them where they're at, or you can take it at the margin and watch your stock price plunge. Top line growth could remain under pressure if Apple does raise product prices, in addition to uneasy consumer sentiment, which might delay upgrades. Even worse, what you could see is companies pulling off their low margin products, only focusing on high-end, high margin where they can afford to take a hit. The issue here is for consumers, this could be a massive lose-lose scenario, and for investors, what happened today could only be just the beginning. Now let's take a look at what some other experts are saying, as this could blow up Apple. And it's hard to imagine Trump blowing up an American icon, but it looks pretty tough. If Apple can't get exempted, that is from the tariffs, we estimate about a 9% negative impact on the company's total gross margin. Jeffries thinks that Apple is going to be exempted, and this could set up a major buying opportunity on the best tech winners on sale for a policy that will be temporary and not permanent. Now, many of you in the comments weighed in over the past several days and said not to worry, that these tariffs will stay on as long as necessary. But one of the issues we're facing, if the U.S. economy plunges into a recession, and at worst, this could plunge us into a potential depression if these tariffs hold long enough and consumers cut spending, well, watch out. The tariffs will come off quickly. Of course, we don't know, but I'd like to know what you think, because some people believe this is going to cause IT budgets to freeze, put a halt on spending, and for companies, that means they're going to see their revenue, their profits plunge, stock price go with it. But I want to know from you, how do you see this play out? Do you think the tariffs are temporary and negotiations are going to come quick and fast, or do you think this is going to be protracted and plunge the U.S. economy in the wrong direction? Or is this the right move at the right time? Weigh in the comments below, because market itself accelerates now as U.S. trade war upends global outlook. And what we saw over the last several weeks is investors, particularly retail investors, buying every dip in the market. They believed that the tariffs would be fairly mild. They believed that President Trump wasn't going to go full force. Now what they're finding out with today's gap down move, that this is a serious blow, not just to the U.S. economy, but the global economy as well. Many now are asking questions, when is this going to end? The fear is what we saw today in the equity markets could be merely just the beginning. The dollar slid by the most in at least 2 decades. Investors pulled cash out of the U.S., saying the euro, yen, and Swiss franc surging. And from a dollar shortage perspective, this is great news for a lot of other countries, because it's taking pressure off the financial system. But from an inflationary standpoint, this is the worst possible news for the United States right now. You think about from other countries, if their currencies are rising, well, this takes pressure off any disinflation or deflationary pulses, perhaps just like China's seen. But for the U.S., it's likely to see inflation. Well, a weaker dollar says inflation is likely to go higher, and that's why we're seeing oil markets react, as oil also fell in concern. Demand will drop as consumers face higher prices. It means less money spent on energy and consumption. Of course, that means oil prices go down. All in told, it amounted to a rapid collective verdict. Trump's push to roll back decades of globalization is almost certain to wreak havoc on the global economy and possibly even set off recessions if it triggers a retaliatory spiral. Do you think we're going to see one economy after the next hit a recession? Do you think we're immune? I want to know from you. Weigh in the comments below, because let's talk about the inflationary hit that comes from the dollar and why it's so dangerous for the U.S. economy. Here we see the consumer price index in blue against the nominal broad dollar U.S. index in red. Let's go back to the years going into the global financial crisis, and what do we see? The dollar is weakening in value and inflation surges higher. This, of course, was the trigger that sent us into the global financial crisis, as we know that wage growth did not keep pace. It led, of course, to companies starting to lay people off after they cut hours and spiraled right into stagflation and an all-out financial crisis. Let's move forward to 2010. What happens? The dollar weakens, inflation turns right up. We can see around 2017 the dollar weakens. Now inflation goes down, but then it starts to head higher. We can see it after the pandemic. A weaker dollar sent inflation skyrocketing, although we can say it's likely magnified due to post-pandemic issues of the supply chains being shut down. But where we're at now is the Fed needs inflation to come down, as well as the Trump administration, and with the tariffs and now a weaker dollar, a double hit. What it's telling us, inflation could head higher, and for many American households that are already cash strapped, this could be the breaking point that causes them to cut spending. And so you turn back to where we started with Apple, and you can see the doom loop starting to take effect. It's a lose-lose situation for a lot of these companies. You raise your prices to maintain your stock price and margin, or you leave it where it's at and take a hit and watch your stock price plunge. Either way, with rising inflation on the horizon, consumers can't afford either one. And until the last minute, investors were living on the hope that trade policy would end up being reasonable and pro-business, that it would avoid the risk of recession. Investors thought Trump would back down, and they found out last night that absolutely that is not the case, that he's going full force and intends to make this stick until he completely rewrites globalization, perhaps in a way that's favorable to us, perhaps in a way we'll lose. We don't really know. I want to know what you think. Do you think this is a move we should have been making years ago, or do you think we're going to fall flat on our face? Because while the markets are plunging, well, we told our subscribers for a CTA Time Pro report, we gave them on April 1st what we said was going to be an amazing trade. It was going to be our tariff beater of the week. Sure enough, it's up. Now, you remember we put a trade on Brazilian equities. 2 weeks later, we were stopped out for a nice 7% gain. This latest trade is already surging higher this week, and you too could have gone in on it, and even the best part, for free. Grab those links in the description below. Get your coupon code for a free 30-day free trial. Stay tuned to the end of the show for more information, because this step was Trump's boldest move yet. Long promised campaign to reshape global trade. Unless negotiated downward, which is now the hope that everyone's starting to price in, that people will come to the negotiating table and make a deal. Of course, the risk is now, if they don't, equity prices, well, this could just be the beginning of a long plunge lower. Will likely royal business supply chain squeeze corporate profits and rekindle inflation, potentially limiting the Federal Reserve's ability to cut interest rates if the economy stalls. Because one thing the Fed hasn't faced, at least in a very, very long time, is effectively man-made inflation. They've not dealt with an economy that there was a massive tariff wall put up that could send prices higher. So from the Fed's perspective, how they'll react, well, the likely answer is they're going to keep monetary policy tight. And I'll tell you why they're likely to do that, for one simple reason, because we know the tariffs went up very quickly. They can go down very quickly, but the Fed doesn't seem to react that quickly to the data or to policy coming out of Washington. This means monetary policy likely to stay tight, interest rates likely to stay in a restrictive territory. And again, for U.S. consumers, they're already struggling under mountains of debt. We're seeing delinquencies rise. Now we're going to see prices go up even more. This could kick off a wave of layoffs, and that would spiral the U.S. economy right into a stagflationary recession. But let's look at the issue that companies like Apple are facing here as we look at what happens when you go into a period where there's rising unemployment and rising inflation. As we look at the CPI in blue, unemployment rate in red, and you can see what happens to corporate profits after tax. That's shown in green on a year-over-year rate of change, and you can see that as unemployment rate and prices rise, corporate profits shrink. This is the issue that Apple's facing. Of course, you go right into the 91 recession. We know stock prices came down. We see the same thing happen going in the dot-com bubble. Of course, we know that tech stocks in particular took a big hit. This time, they're not going to be immune either. We know in the global financial crisis, you see the same effects. Companies are facing, again, a position where they could see their stock price spiral into an all-out doom loop downward, and that is a real risk we're facing, because right now you saw corporate profits, at least as the last quarter, trend higher. We're going to get some updated reports here over the next several weeks from companies, but it's the outlook, my friends, that will matter. We know that inflation likely to head higher, and there's going to be a response to the labor market. We'll talk about that here in a little bit. It's definitely more aggressive than what people were expecting. It's a bigger doom loop for the rest of the world. At least that's the hope, that's going to impact other economies first, send them into a recession, bring them back to the negotiating table. But what a lot of people didn't expect is U.S. equity markets to take the hit they did today. And based on what we're seeing, the tape at the time of filming suggests there could be a lot more pain for investors coming. As federal cuts dominate March 2025 total, with 275,000 announced job cuts, and this is huge. This is a 60% increase from the cuts announced 1 month prior. And job announcements were dominated last month by DOGE's plans to eliminate positions in the federal government. It would have been otherwise a fairly quiet month for layoffs, this according to those who put the report together. And I want to know what you think. Are you pro-DOGE or against DOGE? Weigh in the comments below, because the reality of the situation is people are losing their job at a time the economy may not be able to absorb it. Hiring plans fall to the lowest level since 2012. We saw recently from the JOLTS report the hiring plans reversed. They're not the lowest level from 2012 yet, but companies' hiring plans fell in March. This is dangerous. So far this year, employers still plan to hire, but a 16% decrease from those announced in the first quarter of 2024. It's the lowest Q1 hiring total since 2012, and it's likely in the months to come and quarters that will follow, unless these tariffs are pulled and deals are made quickly and something changes. Watch companies lay off, because they are going to take a hit at the margin one way or the other. Whether it's raising prices and demand goes down or they absorb it, they're going to have to do something, and that's going to be cutting jobs, and in a big way. Here we can see the relationship between job openings and average weekly hours. We know that, again, for many American households, things are going to change in the months to come, and in a big way, because when companies cut job openings, that means they're already cutting hours. And what we can see is, as job openings get cut, hours for existing workers that do keep their job get cut even more, and those two alone could be the trigger that sends us into a recession. At the same time, we're likely to expect prices to head higher. But let's turn to the initial claims data, because right now we're facing on Friday the non-farm payroll report. This is a big one, because remember, Bank of America said if it comes into the sweet spot, which ADP suggested it will back on Wednesday, well, it would show the U.S. economy is facing a soft landing. The question is, will employers now respond with the face of the tariffs and lay people off? Well, at least for last week, they were pretty benign, as we see initial claims remained near historic lows around 219,000. We see on a seasonally adjusted basis, continued claims rose 56,000 to 1.9 million, but are largely around the same range they've been on a non-seasonally adjusted basis, virtually unchanged at 2 million Americans sitting on the unemployment line. Of course, we know a lot of those DOGE workers won't show up immediately on this report. Remember, these are planned layoffs, not actual layoffs that have hit yet. But let's turn to the services sector, because many people said that it would save the U.S. economy, but based on the latest reports today, doesn't appear that's going to be the case either. And ISM services slumps to a 9-month low as employment plunges, following the significant decline in U.S. manufacturing soft survey data. Keep in mind, what did we talk about yesterday? That the hard survey data from the government said that everything was okay. Meanwhile, those that are surveyed holding the actual jobs are saying, no, things aren't that great at all. Here we see the S&P Global's U.S. Services PMI jump from a 15-month low, which is a positive sign, from 51 to 54.4, showing continued expansion in this U.S. services sector. But the gold standard, the ISM Services PMI, said no, the exact opposite happened, went from 53.5 to 50.8, suggesting the services sector stalled out, its lowest level since June of 2024. Let's take a look at both reports. Let's start with the S&P Global, who notes the activity and new business growth did pick up. Now, we know that's likely from the tariffs, as people were front running it. Let's look at the details, because the real issue here is all about the labor market. If that goes, watch out. There's nothing stopping the U.S. economy from plunging into a recession. Although sentiment about future remains downbeat, and of course, when employers are not confident about the future, they're not confident about hiring or giving out hours. Cost inflation, meanwhile, and now at an 18-month high, meaning prices likely to go up. And job growth was also recorded, although to a modest degree in the context of the survey history, amid worries over rising costs. Operating expenses increased in March to the greatest degree in a year and a half, largely attributed to panelists to the impact of tariffs. Competition. This is interesting. It means demand's weakening, limited the ability of firms to pass on higher costs to clients via selling prices. So what we see, job growth increased as businesses push through all of this work, but we see due to weakening demand, we see the prices did go up to the end consumer, but not as much as they could have. And some firms pointed to the new administration's economic policies as likely being supportive to growth. However, reflective of the uncertainty in outlook, concerns persisted over the effects of federal cost-cutting initiatives, and in particular, the role of tariffs in raising prices and dampening overall demand. It's hard to argue that the claim that these policies are going to lead to economic growth in the short term are going to be true. Maybe over a long period of time, over years, I don't know. I want to know from you, do you think that these tariffs are going to lead to an immediate turnaround and growth of our country, or do you think we're going to head into a recession and then see a turnaround, or do you see there's absolutely no positive sign to any of this? Weigh in the comments, because service providers sought to pass on higher costs to clients via an increase in their own charges, as output price inflation, despite picking up since February, remained below trend. Competitive pressures once again and efforts to sustain demand served to limit output price inflation, suggesting that even though the weaker dollar could push inflation up, that the tariffs could push inflation up. What are we already seeing signs of in the services sector? That is less demand. So as prices go up, demand's going to go down even more. That means whatever inflation we see starts to look like just the warning sign we've been saying. That stagflation. Demand goes down enough, employers cut more hours, they cut job openings, and then eventually cut jobs, which is exactly what the ISM says is starting to happen. As we know, business activity index is still expanding, but new order index stalled out at 50.4. Employment index in contraction, meaning net layoffs. As a reason that employment went down, well, the backlog of orders is in contraction. So what we're seeing is everybody front-running tariffs, trying to push through as much new business and old business, and as they run out of business and the expectation is there won't be any future business, well, that means people go, and you can see new export orders plunge. Makes perfect sense of why. And this is a real issue because for Fed officials that are still working to rein in price gains that spiked during the pandemic, the inflationary fallout from the president's action may limit policymakers' ability to step in and bolster the economy. And there's for good reason. Again, the Fed has not faced an administration who's put up large tariffs like this that could lead to big jumps in inflation. Again, the Fed doesn't react to policy put out by Washington, they react to the data, which is part of the issue here, because if the Fed were to react to policy and lower rates, and then all of a sudden the tariff walls came down, it means the Fed would have to respond, perhaps raise rates. What this is going to do is create a lot of uncertainty at the level of the Fed. We'll likely hear at the next meeting. My expectation is they keep policy restrictive. And again, for the U.S. economy and the U.S. consumer that's already running out of money, this is a dangerous sign. But just because that's happening doesn't mean you can't make money in these markets, because our machine positioning report, the CTA Timer Pro, identified an amazing trade back on April 1st. We told our subscribers on the open to buy it. Now, how did we know? Because each and every day we scan the broad equity, bond, commodity, and currency markets, and we look at machine positioning and how they're holding. But we do something special. We run a historical overlay, so we know when the machines are likely to be buyers, so we can position our subscribers ahead of that. And we know when they're likely to be sellers, so we can tell them to get out. And the best part is all that data is right integrated into our hot list. And every day we again scan all of those markets and give you the reporting on where we think the machines should be positioned so you can trade accordingly. Now, you get the daily report, you get all the signals from the report, but I review them and give you my opinions on the trades I think you should take. All the data integrated right into it. You get full risk control levels, a tracking of all our open trades in return, a weekly update, disclosure on how I'm trading my own reports, and here's the best part, you don't even have to pay for your first 30 days. It's on me. Use the links in the description below. Be sure to put that coupon code in. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.